Hello, I'm Yutaka Watanabe, a tax accountant. This is the channel Tax Accountant Nabe solves your money problems. Today, I will talk about tax audit of corporations that have not filed tax returns. The theme is quite simply the domino effect of failing to file corporate tax returns. When you are busy with day-to-day business, troublesome administrative work can easily get pushed back, right? I understand that feeling very well. However, that smart act of putting it off can become the first push in a fatal domino collapse for a company. That is the chilling reality that begins to appear. Today, I will organize this complex and frightening process clearly and explain it in an easy-to-understand way. First, let's start with a very direct question. What exactly happens if a corporation does not file a tax return? Some of you may be thinking, well, the tax office is busy, so maybe a small company like ours will be overlooked. It is like a strategy of flying low under the authorities' radar. But let me be very clear. That is not a strategy at all. It is simply a time bomb. Facing this question head-on is the most important starting point for understanding reality. To state the conclusion first, corporations that have not filed tax returns are highly likely to become major targets of tax audits. In other words, the state of being unfiled itself is like waving a big red flag at the tax authorities and saying, "This place looks suspicious. Please investigate." The authorities are not choosing audit targets blindly. The abnormal fact that there is no filing data is immediately identified by the system. Please completely discard the illusion that can keep it hidden. Now, let's move into the main topic. Under the theme, the reality of a tax audit, exposing hidden numbers, let's look at the actual audit process. Tax auditors work in a very systematic way. First, in step 1, they check every corner of the company's books. Next, in step 2, they compare them with transaction records such as bank histories. Finally, step 3, based on the solid evidence that emerges from that process, they calculate the proper income and tax amount precisely. Just because a company neglected to file does not mean the numbers magically disappear. Rather, under the strict eyes of professionals, the hidden figures are completely exposed. The next theme is the truth about heavy penalties, the dominoes being to fall. After an audit begins, the situation escalates all at once. If the company had filed properly by the deadline, it would only have had to pay the original tax amount. But when failure to file is discovered, heavy penalties are added on top of the original tax. Not only the original tax, but additional penalty-like amounts are added as well. A truly crushing reality awaits. Let's break down the contents of those penalties. First, the base principal tax is imposed. That is only natural. But the truly frightening part starts from here. In addition to principal tax, an additional tax for failure to file is added heavily as a penalty for missing the deadline. Furthermore, the delinquent tax, which increases like interest for the number of days delayed from the original payment due date, is added without mercy. The more time passes, the heavier this domino of delinquent tax becomes. The longer you leave it alone, the more the final burden grows like a snowball. Now, we finally come to worst-case scenario, estimated taxation. This is the risk of completely losing control over your own company's numbers. If the failure to file is left unattended, this may be carried out. What this means is that if you do not submit books or do not cooperate with the audit, the tax authorities may unilaterally impose tax based on their own estimate, using data from similar companies or past trends, saying your tax amount is properly around this much. At that point, even though they are the numbers of your own company, you lose all control over them. Even if estimate is higher than the actual situation, you may be driven into a state where it is extremely difficult to object. If we express the final destination of this terrifying domino collapse in other phrase, it is this. The risk of large amount of tax being imposed all at once. It really sends a chill down your spine. A massive amount of tax, swollen to the limit by additional tax for failure to file. Delinquent tax and even estimated taxation may suddenly be built all at once with the message, please pay this. If that happens, the company cash flow can be wiped out in an instant. In the worst case, it can become a fatal blow directly leading to bankruptcy. It is truly the giant iron ball waiting at the end of the domino collapse. Now, to continue this explanation, let me ask you a slightly tough question. Are your companies resourcefully prepared so that they can withstand a renewal by the authorities at any time? Or will you leave everything unattended and continue carrying the nightmare risk of estimated taxation? The domino collapse that starts with failure to file will never stop on its own halfway through. How you receive this information and how you act on it is up to you. This time, I spoke on the topic, tax audit of corporations that have not filed tax returns. For tax audit, please visit the page of Yutaka Watanabe, Tax Audit, Tax Accountant Office. I will continue talking about themes related to money, so please subscribe to the channel. Tax Accountant Nabe solves your money problems.